Somewhere in a Wall Street office right now, a fund manager with an Ivy League MBA and a $200,000 salary is quietly losing to a math formula that requires zero sleep, zero salary, and zero opinions. Welcome to one of the most important money concepts a beginner investor can ever learn. We are talking about index funds, why they have a reputation for winning over time, how to build a simple portfolio with just 3 of them. And yes, we will also be honest about the downsides because no strategy is perfect. Grab a notebook because this one is worth writing down. Let us start with the core philosophy. Why do index funds win? Think about the stock market as a giant ocean. Every fish in that ocean represents a publicly traded company. Active fund managers, the people who run traditional mutual funds, are essentially professional fishermen. They are out there every single day casting nets, analyzing which fish to catch, which to release, and timing every move with expensive research teams and sophisticated tools. They charge you for all of that work. And here is the uncomfortable truth. Most of them still come home with fewer fish than the ocean naturally produces. An index fund does not try to beat the ocean. It simply owns a piece of everything in it. If you buy a total stock market index fund, you now own a tiny slice of thousands of companies simultaneously. When the market grows, you grow with it. You are not trying to outsmart the ocean. You are the ocean. This concept is backed by decades of research. Study after study shows that roughly 80 to 90% of actively managed funds underperform their benchmark index over a 10 to 15-year period. And the few that do outperform in one decade rarely repeat that performance in the next. Consistency is the enemy of active management and the best friend of index investing. Now let us talk about something that trips up a lot of beginners, and that is market volatility. The stock market is not a smooth upward escalator. It is more like a hiking trail through mountains. Some years you are climbing hard. Some years you are sliding down into a valley wondering why you ever started hiking. But here is what matters. Zoom out on any long-term chart of a broad market index, and the trail always ends higher than it started, assuming you are looking at a long enough horizon. Index funds are particularly powerful for long-term investing for this reason. Because you own everything, a market crash does not wipe you out the way a poorly timed bet on a single company might. When one sector falls, another might rise. You ride the wave up and you absorb the dips without catastrophic loss. Time becomes your most powerful asset. The longer your timeline, the less any single down year actually matters to your final outcome. Now let us look at one of the biggest concrete advantages, the cost difference. And I want to show you a comparison that makes this crystal clear. When you compare low-cost index funds to actively managed mutual funds, the differences are striking. Starting with management fees, also called expense ratios, index funds from providers like Vanguard or Fidelity often charge somewhere between 0.03 and 0.20% annually. Actively managed mutual funds commonly charge anywhere from 0.50 to over 1.50% per year. That sounds small, until you realize that over 20 or 30 years, a 1% difference in fees can literally cost you tens of thousands of dollars in lost compounding. On historical average returns over 10 or more years, index funds tracking the S&P 500 have historically returned around 9 to 10% annually on average before inflation. Actively managed funds, after fees, have historically averaged lower than that, often landing in the 6 to 8% range, with enormous variation depending on the manager and the year. Then there is what I like to call manager risk. With an index fund, there is none. The fund simply follows a predetermined index. Nobody can make a bad call. Nobody can panic, retire, or get replaced mid-strategy. With an actively managed fund, your performance is entirely tied to the skill, availability, and decision-making of a specific human being. That human can have an off decade. That human can leave. That human can make one catastrophic call that drags the entire fund down. Index funds remove that variable entirely. So how do you actually build a simple but powerful index fund portfolio? This brings us to the 3-fund portfolio, which is one of the most beloved beginner strategies in personal finance communities, and for very good reason. The 3-fund portfolio is exactly what it sounds like. You build your entire investment portfolio using just 3 funds. The first fund is a total U.S. stock market index fund. This gives you exposure to thousands of American companies across every industry and company size. Think of this as your foundation. The second fund is a total international stock market index fund. This broadens your reach beyond U.S. borders, giving you exposure to companies in Europe, Asia, emerging markets, and beyond. The third fund is a U.S. bond market index fund. Bonds are generally lower risk than stocks. They add stability to your portfolio and act as a cushion during stock market downturns. Common funds used for this strategy include offerings from Vanguard, like VT-SAX for total U.S. market, VT-AX for international, and VBTLX for bonds. Fidelity offers comparable zero-expense ratio options. Schwab also has competitive low-cost versions of all three. Why is this considered a winning strategy for beginners? Because it is brutally simple and remarkably complete. With 3 funds, you own thousands of companies across multiple countries and asset types. You are diversified across geography, industry, company size, and risk level. You are paying almost nothing in fees. You are not dependent on any single manager or any single company succeeding. And most importantly, you can maintain this strategy without spending hours every week managing it. You rebalance once or twice a year and get on with your life. The simplicity is not a weakness. It is the entire point. Complexity in investing almost always benefits the person charging you for it, not you. Now here is where we get honest, because intellectual honesty is part of being a real financial educator. Index funds are powerful, but they are not without real limitations. First, index funds are designed to match the market, not beat it. If you are someone who genuinely believes in a specific industry or technology wave, and you want to position yourself to potentially outperform, index funds will always cap your ceiling. You cannot get more than what the market delivers. Second, during broad market crashes, index funds fall too. Because you own everything, when everything drops, you drop with it. There is no defensive maneuvering available. If 2008 or 2020 style crashes make you emotionally want to sell everything, that emotional response can actually destroy the mathematical advantage index funds provide. The strategy only works if you stay in. Third, index funds by definition include bad companies alongside great ones. You do not get to exclude companies that conflict with your values or that you believe are fundamentally overvalued. Some investors genuinely care about this, whether for ethical reasons or analytical ones. When might someone choose a different strategy? If you have a very short investment timeline, say under 5 years, the stock market volatility risk becomes much more significant, and a more conservative or targeted approach makes more sense. If you have specific domain expertise in an industry, you might reasonably believe you can identify opportunities the market has not fully priced in. If you are a high net worth investor with complex tax situations, a financial advisor might construct a more tailored strategy that indexes simply cannot match. These are legitimate reasons. Index investing is not the only answer. It is just the most consistently reliable answer for most people most of the time. Here is the bottom line. The reason index funds win is not magic, it is math. Low fees compound into massive gains over decades. Broad diversification reduces catastrophic risk. Removing human emotion from the equation prevents the most costly investment mistakes. And the simplicity makes it sustainable for real people with real lives who do not want investing to become a second job. Your inactive neighbor figured this out. Now you have too. The best investment strategy is the one you can stick with for 30 years without losing sleep. For most beginners, that strategy starts and ends with index funds.